Welcome. In this video, will ZBCN coin boom again? We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand.
First of all, the statement that there is such a downtrend and that the price needs to break above it points to a very critical situation in technical analysis. This is because a downtrend line shows that selling pressure in the market is strong, and every time the price tries to recover, sellers step in and push it back down. In other words, a downtrend essentially reflects persistent market weakness, showing that buyers have not yet gained strong control while sellers continue to play a decisive role in the general flow of the market. In this case, the price breaking above this downtrend carries great psychological as well as technical significance. This breakout signals that sellers are beginning to lose control, buyers are stepping in more forcefully, and the price may be about to find a new direction. A downtrend line always acts like a visual barrier connecting resistance points in the market. As long as the price remains below this trend line, the dominant direction still appears to be downward to market participants. But when the price breaks above this trend line, it indicates that the persistent selling pressure is starting to ease, and the psychological balance in the market is shifting. This is because every downtrend breakout is proof that the area where sellers easily pushed the price down in the past is now being defended by buyers. In particular, the breakout of a strong downtrend that has lasted for a long time is perceived as a development that restores investor confidence and signals that the price may enter a healthier upward move. At this point, it's also worth addressing how the price breaking above a downtrend affects investor psychology. While the price moves below the trend, most investors operate under the assumption that every rally is a selling opportunity. That is, whenever the price rises, sellers step in and the market turns downward again. But when the price breaks above this trend line, this perception in investors' minds gradually begins to change. The idea that every dip is a buying opportunity begins to dominate. This shift is known as the strongest aspect of trend breakouts, because a change in market direction is not just about technical levels, but also about psychological barriers. Breaking above a downtrend shows not only that buyers are gaining strength, but also that new momentum is forming in the market. Momentum is a very important concept for understanding which direction the market is leaning toward, and in which direction it can move faster and stronger. When a downtrend is broken to the upside, momentum shifts from sellers to buyers. This provides a strong foundation for the price to test new higher levels. Especially if this breakout is accompanied by a notable increase in volume, the signal becomes even more reliable, as the rising trading volume indicates that the breakout is backed by strong market participation. Another important factor is the possibility of the price making a retest move after breaking a downtrend. Often, after the price breaks a downtrend to the upside, it pulls back in the short term to test this trend line. When this retest is completed successfully, meaning the price holds above it and it begins to act as support instead, buyers' strength is once again confirmed, and the probability of further upside increases. For this reason, while a breakout above a downtrend can be seen as a signal on its own, the subsequent testing and confirmation process is often considered an even stronger confirmation by investors. One of the most critical consequences of breaking above a downtrend is that it lays the groundwork for a trend reversal in the medium to long term. Because if the price has been stuck in a downward channel for a long time, there has been a persistent atmosphere of pressure for investors. But breaking out of this channel signals that the previous downtrend is now behind and that a new upward phase in the market may be beginning. For this reason, many technical analysts see the breaking of trend lines as a turning point for understanding the market's future direction. Breaking a downtrend can influence not only technical aspects, but also fundamental investment strategies, because when the trend breaks, many investors enter the market with different strategies. Some prefer to buy at the moment of breakout, while others wait for the price to retest the trend. For some investors, this breakout is considered the start signal for a medium-term investment. Therefore, breaking above a downtrend brings together different types of investors at the same point, which helps the price gain stronger upward momentum. When a market breaks its downtrend line, it also indicates that a new story is beginning. Because as long as the price remains squeezed below a downtrend, expectations in the market become increasingly negative and investors lose confidence. But when the price breaks this chain, new hope emerges both technically and psychologically. This hope encourages buyers to enter the market, brings in new participants, and accelerates upward price movement. Especially in markets that have been moving downward for a long time, such breakouts are critical thresholds that bring investors back into the market. In conclusion, breaking above a downtrend is considered one of the strongest bullish signals in technical analysis. This is because it not only shows that the price has broken through a linear resistance, but also indicates that the psychological balance in the market has shifted. As sellers lose strength and buyers take control, this signals the start of a brand new story in the market. Therefore, breaking above a downtrend is a highly valuable turning point for market participants and is often the forerunner of a new uptrend. That's why the statement that the price needs to break above the downtrend expresses much more than a simple technical observation. This statement encompasses the shift in market power, the breaking of psychological barriers, the change in momentum, and the emergence of new opportunities. In this respect, it serves as a warning that every investor should take into account and offers important clues about the future movement of the price. But we can't rely on trends alone for analysis, so let's take a look at other metrics as well. Stay tuned.
When a downtrend forms in the RSI indicator, it generally shows that market participants are moving under increasingly weakening momentum, indicating that even if prices show upward reactions, the RSI creates lower highs, signaling seller pressure. However, when this descending trend on the RSI is broken, especially if it happens in alignment with the price chart, it indicates that the market may be gaining new momentum. This is because RSI is not only an oscillator that points out overbought and oversold zones, but also a powerful technical analysis tool that can be interpreted through trend lines and patterns. A descending trend line on the RSI essentially represents the momentum side of the pressure continuing over the price. When this trend breaks, strong buying appetite often steps in, as this breakout gives investors a sort of psychological threshold signal. With this signal, the probability of prices moving higher increases significantly, and the possibility of a rally emerges. One of the most important features of RSI downtrend breakouts is that they often provide earlier signals than price breakouts. For example, the price may be testing a resistance area, but has not yet managed to break it, while the RSI at the same time breaks its descending trend to the upside. This often indicates that the price may soon make an upward breakout. This is why many professional investors view trend breakouts on the RSI as a leading indicator of possible breakouts on the price chart. When the RSI shows that momentum has shifted and seller pressure has been broken, the market is usually supported by stronger buying waves. This accelerates the upward movement in price. After such breakouts, an increase in volume is often observed. This is because investors waiting on the sidelines see a buying opportunity once the RSI breaks its downtrend and quickly take positions. This positioning creates a chain reaction. Following the first buyers, other investors also notice the beginning of the uptrend and join the price action. Thus, a move that starts with an RSI breakout can turn into a rally. The reason behind this is not only the technical signal, but also the effect this signal has on investor psychology. When the RSI breaks, the perception that the decline is over, a new uptrend is starting, pushes the price higher. A downtrend breakout in the RSI indicator is also one of the strongest technical signals that bears have lost strength. As long as the downtrend continues, sellers have managed to exert pressure at increasingly lower peaks. But when a breakout occurs, this pattern is disrupted. Sellers can no longer maintain pressure at lower highs, and buyers begin to establish new dominance. Once this psychological threshold is broken, market dynamics completely change. These breakouts often mark the beginning of long-term uptrends, especially if they align with price movements. In particular, RSI downtrend breakouts can have much more dramatic results in the cryptocurrency markets. This is because the vast majority of investors in these markets closely follow technical indicators. When the RSI breaks, this can turn into a collective buying move. Investors do not want to miss out on the signal given by the RSI and quickly join the prices. Therefore, RSI trend breakouts are not just a technical detail, but a strong catalyst that directs market participants. The real spark that initiates upward price movement is often the RSI breakout. Another important point is this. RSI trend breakouts usually indicate not just a temporary move, but often signal long-term trend changes. If a descending trend line has lasted for weeks or months and eventually breaks to the upside, this can bring not just a few days of gains, but the potential for a much longer rally. For this reason, investors who follow RSI breakouts value this signal not only for short-term profits, but also to anticipate long-term trend reversals. This feature of the RSI distinguishes it from many other indicators. Sometimes price charts can show misleading breakouts, but trend breakouts on the RSI often work as a more reliable signal. Another factor to watch when a downtrend breaks is the position of the RSI. If the breakout occurs near oversold regions, it indicates that buying pressure will likely kick in much more strongly, as the market is emerging from an oversold area and preparing for a new rally.
If the breakout occurs above the 50 level, it confirms that the market has moved past the neutral zone and is entering an uptrend with stronger footing. Therefore, in RSI trend breakouts, not only the break of the line, but also the level at which the breakout occurs is important. RSI trend breakouts can also reveal hidden divergences in price movements. For example, while no clear uptrend is yet visible on the price chart, a breakout in the RSI downtrend can give investors a hidden bullish signal. In such cases, the RSI breakout is often the precursor to a strong future rally in the price. Professional investors notice these divergences, take early positions, and profit from the very first steps of the rally.
When a pennant formation appears, its most important characteristic is that the price first creates a flagpole with a strong upward or downward move, followed by a short-term consolidation phase resembling a narrowing triangle. In other words, the price first draws all the market's attention with a vertical move, then starts to tighten for a while. During this tightening, some investors take profits while others look for new opportunities. The critical point is when the price breaks the upper line of this narrowing area, at which point the move accelerates again in the direction of the previous trend. This is because, by its nature, a pennant is a continuation pattern. In other words, whichever direction the initial strong move took, the breakout of the formation generally occurs in the same direction, and the market gains new momentum. Breaking the upper line essentially shows that sellers have lost their strength during the consolidation phase and buyers have become dominant. After this breakout, the price has the potential to rise by the length of the previous flagpole. The logic behind this is as follows. The initial strong rise reveals the market's strong appetite in the direction of the trend. The following short-term rest and tightening act as a kind of energy-gathering process. When this energy is complete, the price turns upward again and typically mirrors the length of the previous move by climbing the same distance. This is why technical analysts who identify a pennant formation pay close attention at the breakout point and consider this breakout one of the strongest signals that the trend will continue. One of the most important details to pay attention to while the formation is working is its relationship with volume. If the price breaks the upper line with a noticeable increase in volume, it confirms that the breakout is genuine. If the volume remains low, sometimes the price may show a brief rise but then pull back into the consolidation. However, a breakout supported by strong volume signals that buyers have entered the market in force and that the trend will continue. In this case, the likelihood of the price rising by the length of the flagpole increases significantly. A pennant formation breaking the upper line also carries special meaning in terms of investor psychology. During the tightening zone, most investors are in a state of hesitation. Some believe the price might fall, while others believe the trend will continue. But when the price breaks the upper line strongly, a significant portion of those who were hesitant also begin to take long positions. This further accelerates the rise. In other words, the breakout is not only a technical turning point, but also a psychological one. The probability of the price rising by the length of the formation is something that has proven itself countless times in the past. Looking at many charts throughout market history, it's clear that after a pennant formation, breakouts have in most cases brought a rise equal to the length of the pole. That's why technical analysts consider this measurement when setting a target price. For example, if the pole length is $100 and the price is broken the upper line, then after the formation is complete, the price is expected to rise at least another $100. This expectation is further reinforced by the collective belief of market participants in this structure. Since a significant portion of investors are watching this target, it becomes more likely that the price will move in that direction. The pennant formation is among the most reliable structures showing the strength of a trend. This is because, rather than merely guessing that a price move will continue, it provides strong technical evidence. Moreover, the durations of this formation are generally short. It usually appears not in very long-term moves, but in medium-term swings. This offers investors an opportunity to gain profits quickly. As the price tightens during the formation, anticipation builds, and at the breakout moment, this anticipation often explodes. After this surge, the price's rapid climb is seen by most investors as evidence that the trend is continuing in a healthy manner. Another important feature of this formation is that it helps investors with risk management. This is because the lower line of the formation, the support level, naturally serves as a reference for setting a stop-loss level. If the price fails to break the upper line and instead breaks the lower line, the formation becomes invalid, In this case, investors have clear stop-loss levels to minimize their losses. However, once the formation breaks the upper line, the risk-to-reward ratio shifts strongly in favor of the investor. This is because there is an upward target equal to the pole length and limited risk below. This balance is one of the reasons why the pennant formation is among the most preferred structures. The rise that begins when the upper line is broken is often supported not only technically, but also by fundamental dynamics. For example, positive news in the market, strong buying waves, or increased investor confidence may fuel this rise further. In such cases, the price may not only cover the pole length, but sometimes move much further. In other words, the formation's target should be seen as a minimum expectation while keeping in mind that much larger gains may be possible depending on market momentum. In conclusion, when a pennant formation breaks the upper line, the price rising by the length of the pole is not just a graphical prediction, but also the result of market psychology and a structure that has been tested countless times before. This formation provides a reliable technical signal, guides investors' expectations, and is highly advantageous in terms of risk-to-reward ratio. That is why when such a structure appears on a chart, especially when the breakout is supported by strong volume, it draws investors' attention and is considered one of the strongest signs that the trend will continue.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.